You measure every cost, but what about the ones you can't see?
Today, I'll show you how one invisible cost is reshaping the math of every project. For decades, project economics followed a simple formula: cash in minus cash out equals value. But in today's ESG-driven world, that's no longer enough. Because there's a cost we've ignored for too long: carbon. It doesn't appear in your budget, but it exists in every decision, every shipment, every kilowatt of energy used. Ignoring it today only means paying more tomorrow through penalties, offsets, or lost access to green financing.
The question is, should we price carbon? It's how much value do we lose if we don't?
As this chart shows, adding a $3 million annual carbon cost can instantly cut EBITDA by 8 to 10%. That's not an environmental penalty. That's lost profit.
Every project emits carbon, and every emission is a future cost waiting to surface.
Every project consumes energy, materials, and logistics, all of which release CO2. In the past, emissions were externalities. Now, regulators and investors are making them financial realities through carbon taxes, emission trading schemes (ETS), carbon border adjustment mechanisms (CBM), internal carbon pricing within ESG-aligned firms. A project emitting 50,000 tons of CO2 per year at $60 per ton carries a $3 million annual carbon cost. If not booked today, you'll pay later through offsets, fines, or lost ESG access. Notice how even a small increase in carbon price, say $20 per ton, erodes profit margins fast. That's how unseen costs silently reshape your project's economics.
Carbon pricing isn't an environmental fee, it's the cost of future volatility.
Carbon pricing behaves like a risk premium. It internalizes volatility and uncertainty into your financial model today. Adjusted operating margin equals base margin, emission volume times carbon price. And the key? Carbon prices are never static. They fluctuate with regulations, markets, and political shifts. Projects with 10 to 20-year lifespans must simulate scenarios. Optimistic, $50, $70 per ton base. $60, $120 per ton stress. $60, $200 per ton. When carbon is priced at $60 per ton, your project IRR may be 14%. At $120, it drops to 10%. At $200, it can turn negative. Forecasting this range protects your portfolio from future policy shocks.
If you price carbon on day one, you won't panic on day 180.
Organizations that integrate carbon early gain clarity and credibility. There are 3 key integration stages. Feasibility stage. Apply internal carbon pricing to test financial viability. Design and procurement stage. Compare low emission versus conventional materials using levelized cost of emissions, LCE. Operational stage. Track actual carbon output against the carbon budget in real-time dashboards. Switching from diesel to hybrid generators may raise CAPEX by 5%, but reduces OPEX by 15% once carbon tax is applied. That's not just sustainability, it's financial prudence. The upfront cost looks higher, but the long-term savings compound year after year.
In the new economy, carbon isn't a footnote, it's a line in your cash flow.
Forward-thinking companies treat carbon as a financial variable, tracked just like FX or inflation. Adding a single line called carbon cost changes the story completely. Projects that looked profitable suddenly reveal hidden margin erosion. Carbon isn't an ESG detail, it's a profitability metric.
A great CFO doesn't just track spending, they forecast costs before they appear.
Modern finance teams use a suite of tools to embed carbon into forecasting. Carbon-adjusted cash flow templates IRR/NPV scenario simulators linked to carbon pricing MAC, marginal abatement cost curves. To visualize which investments yield the best emission reductions, real-time carbon dashboards fed by IoT and supply chain data. MAC helps prioritize which carbon reduction projects deliver the highest return per dollar spent. It turns sustainability into an investment map, not a checklist.
The companies that price carbon early unlock capital early.
Integrating carbon isn't a burden, it's a competitive advantage. Organizations that measure and forecast carbon gain access to green bonds and ESG-linked loans, preferential tax incentives, CBM-ready export advantages, lower cost of capital due to lower risk rating. The cleaner the project, the cheaper the capital. Investors reward transparency, predictability, and emission discipline. Tomorrow's project economics will not ask, how much does it cost to build? They'll ask, how much will it cost to emit? By embedding carbon costs into forecasting and budgeting, finance teams move from reactive compliance to proactive control. Carbon is no longer invisible. It's the new financial line item that defines credibility, capital access, and long-term value. Price it early. Track it always. Forecast it like it matters.
If this showed you carbon real cost, subscribe for more finance sites.
Green zone labeled value retained. Together, we'll build a future where finance and sustainability move in the same direction.